Is investing in the Tata AIA Capital Guarantee Solution Plan the smart investor's dream or a cautious saver's compromise? Let us find out the answer to this question through an in-depth analysis in this video. Hi there, welcome back to holisticinvestment.in, where we help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. Now, before analyzing this policy, let us first understand a few basic details about it. So, this policy is a combination of Tata AIA Life Insurance Smart Income Plus Plan and Tata AIA Life Insurance Fortune Pro or Tata AIA Life Insurance Wealth Pro Plan. So some of the key features of the policy are: it ensures your family's financial security with a life cover that increases over time, offering enhanced protection in case of an unfortunate event. So you can enjoy peace of mind with guaranteed returns, ensuring that the premiums you pay are protected. And you can pay premiums for a limited period, just 7 or 10 years, while enjoying coverage for policy terms of 15 or 21 years respectively. And you get the flexibility to invest in a range of fund options tailored to your financial preferences. And there's a portion of your premium which you can invest in market linked funds, helping you benefit from potential market growth. And you can also choose how much of the guaranteed benefit you wish to receive, like 80%, 90% or 100% based on your annualized premium. And after completing the mandatory 5-year lock-in period, you can enjoy the option of making partial withdrawals to meet interim financial needs. So these are some of the key features of the policy. Now, as we have a basic idea about it, let us move on to the analysis part of the video, where we are going to analyze the internal rate of return of this policy by calculating it based on the benefit illustration given in the policy brochure to help us make a more informed decision. So for calculation purpose, let us assume that a 35-year-old male has purchased this policy with a sum assured of 53.17 lakhs. So a policy term of 15 years and a premium payment term of 7 years. So he has chosen to pay an annual premium of 5 lakhs. So if he pays all his premiums regularly, he is eligible to receive a guaranteed payout of 18 lakhs 5,600 rupees during the final 2 years of the policy. Additionally, at the end of the 15-year policy term, he receives the fund value which is linked to market performance and therefore not guaranteed. That's why we are going to calculate the future rate of return on an assumed 4% annual return and at another at 8% per annum. This is just for example purpose. These are not guaranteed returns and they also do not indicate the only potential outcome you can get from this policy. The actual value will depend on the policy's performance. So this is just to show you how this policy can perform at two extremes, in a worst case scenario and in a best case scenario. So at 4% scenario, the fund value at maturity is estimated at 16.12 lakhs, resulting in an internal rate of return of approximately 3.48% as per the policy's maturity calculator. At 8% scenario, the fund value increases to 25.74 lakhs, pushing the IRR to about 4.94% as per the policy's maturity calculator. So despite the market exposure, these projected returns are modest and comparable to or even lower than conservative debt instruments. So over long investment horizons, equity-based investments are generally expected to outperform inflation and generate higher real returns. Therefore, investors considering this plan as an equity-oriented wealth creation tool may find the growth potential underwhelming. While the plan does offer capital protection and some guaranteed payouts, its overall return potential appears to be limited. So careful consideration is required to assess whether this aligns with your financial goals and long-term investment strategy. Now, as this policy is not giving us a desirable outcome that we need, let us move on to another comparative analysis where we are going to explore an alternative strategy in which we are going to separately invest in insurance and investment and compare that returns with this plan with a more flexible and transparent alternative by using the similar parameters for a more fair comparison. Suppose an individual opts for a pure term life insurance policy for life cover with a sum assured of 50 lakhs which covers a term of 15 years with a premium payment term of 5 years. The annual premium for such a policy would be around only 17,200 rupees. So this creates a surplus of 4,82,500 rupees each year if you compare with the 5 lakh premium you had to pay to the Tata AIA policy. So this amount can be invested independently. Depending on the individual's risk appetite, this amount could be allocated to either equity oriented investment for higher growth or debt instrument for more stability. In this example, we assume the surplus is invested annually in an equity mutual fund because as this policy also has market link risk, we are going to choose a market link risk product because for a fair comparison. So to maintain consistency with the previous policy's payout structure, we have stimulate a withdrawal at the end of the 14th year by reinvesting the maturity corpus in a fixed income instrument earning 7% interest. So based on this approach, the total accumulated wealth grows to approximately 1.10 crores after taxes. The final investment value stands at 99.17 lakhs, translating to an impressive internal rate of return of 10.56%. So the strategy not only significantly offers you better returns but also provides you with greater flexibility and liquidity. So in essence, separating insurance from investment not only streamlines your financial planning but also enhances your long-term wealth creation potential, making it a smarter and more rewarding choice. So what is the final verdict? Is investing in the Tata AIA capital guarantee solution worth or not? So this policy combines life insurance with maturity benefits. However, these maturity benefits are only partially guaranteed with the remaining portion tied to market performance. While the idea of guaranteed returns may seem attractive, a closer look at the returns reveals that the plan delivers a poor overall yield. So as a bundled product, this policy fails to add meaningful value to an investor's portfolio. It neither offers sufficient life cover nor delivers robust long-term wealth creation. So the combination of subpar returns and compromised insurance coverage makes this policy an unsuitable choice for those seeking financial efficiency, and it also has a high agent commission. So a more effective strategy is to separate insurance from investment, choosing a pure term life insurance plan which provides you with substantial life coverage at a relatively low premium. The remaining funds can be strategically invested in high growth avenues such as equity or debt mutual funds, depending on your risk tolerance, financial goals, and investment horizon.
If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.